Hello, CA Foundation champs. Hope you all are doing amazing. In this video, let's revise the concepts of depreciation and also look into most important questions which becomes a must do for your practice before you face the final exam, guys. Let's begin the session. Depreciation. Depreciation is charged on fixed assets. Now, this fixed assets can include both tangible as well as intangible assets. Depreciation is a non-cash expenditure and does not affect the cash flow statement. Why is this a non-cash expenditure? Literally speaking, guys, it is just the reduction in the value of asset. Nothing we will have as an out-of-pocket expenses. So hence this becomes a non-cash expenditure, and cash flow statement mainly deals with inflow and outflow of cash. So hence this will not impact our cash flow statement. Next, value of such fixed assets decreases over a period of time. Definitely, depreciation is nothing but reduction in the value of assets. What are the factors which results in the depletion of value of assets? It could be due to usage, due to normal wear and tear, passage of time, obsolescence of technology, and market changes. First, due to usage, you literally use the asset. Definitely, the efficiency of the usage of assets will not be same as you use it in the beginning when it is brand new. Next is normal wear and tear. Just by keeping the asset idle, also the efficiency of the asset is definitely impacted. Then passage of time, same factor, and then obsolescence of technology and market changes. What is this obsolescence? See, here I have mentioned in the last point. It means decline in the value of fixed assets due to what factors? Due to innovations and inventions, which is an external factor. So this is not completely in your hand. This is an uncontrollable situation wherein we find some new innovation, some new technology which can override your particular functioning of an asset, and this also impacts your depreciation. Yes, depreciation of a fixed asset starts from when it is actually available to use. So this point is very clear that it is in accounting we will charge depreciation when it is actually available for use. So it is not pointing out with respect to ready to use. Yes. Next, Schedule 2 of the Companies Act prescribes the rate of depreciation for companies. Now, practically speaking, we will definitely require rates, percentage to charge depreciation on the respective assets. So, where can we refer this for? This is given in Schedule 2 as per Companies Act. Yes. Next, depreciation is not chargeable on land as the useful life of land is unlimited. So definitely land will have an infinite useful life. So when the usage or due to any other factor, we cannot consider land as a depreciable assets. These are some important points which you are supposed to look at. Another important topic which comes here is component based depreciation. I've just summarized this point. What is this component based depreciation? See, first of all, what is the requirement? What is the requirement all about to follow component based depreciation? Accounting Standards and Companies Act requires component based depreciation because it is mandated as per the statute. We will require the application of component based depreciation. When will this become necessary? There are certain factors which needs to be looked into. See, each part of property, plant and equipment with significant cost. The significance is very important here. In relation to total cost must be depreciated separately. So if we have different set of parts involved which is contributing to a total assets, and if that part has a significant cost in comparison with the total cost of property, plant and equipment, that will be treated based on the component based of depreciation. Yes, then how to identify this? See, there are two pointers which we can see. First, there should be a significant cost compared to overall cost. In simple words, what you can understand is there should be a breakup for all the part of the cost. And then different estimated useful life or different depreciation method from rest of the parts. Now, for example, if I take aircraft as my asset, so for aircraft, there are different parts which I can break off. So one would be the external seatings and the other would be the engine of aircraft, like that different set of assets. So if these assets will have a separate cost Along with that, we'll have a separate useful life. Definitely, engine cannot be run for at least 20 years if I consider 20 years as life of an aircraft. So I can estimate it could be around 5 years. So in this case, there is a separate useful life available for a component of an asset. Then there could be sometimes different depreciation method also applicable. So in this consideration, it becomes important. See here, the both conditions, that is A and B, must be met in order to follow component based depreciation. So if this satisfies, what are the grouping rules? Can components be grouped? Yes. Now what does components be grouped means? If the parts of the asset, that is components of the asset, have similar useful life, so those can be grouped. See here, if significant parts have same useful life, along with that depreciation method, they can be grouped for depreciation charges. So it becomes easier in order to calculate depreciation when the groupings are done. So let's understand this with an example. So just to understand how the component depreciation works, see, there is an industrial printing press. Now in this industrial printing press, there are several parts like main press unit, electronic control panels, reducing option, and inking and drying system. So if you find out, is there a breakup available of cost? Yes. So main press unit is worth 20 lakh. The useful life here is 15 years and the method used is straight line method. Electronic control panels cost is separately available, that is 5 lakh. Useful life is 5 years and they followed reducing balance method. Inking and drying system cost is 4 lakh. Useful life here is 8 years and the method used is straight line method. Now if I have to apply the concept of component based depreciation, my first point is to check whether the cost which is given for the separate component is significant in relation to total cost. If you observe, 5 lakh and 4 lakh are definitely significant to the total cost of 20 lakh. Along with that, is there a different estimated useful life available for each components? Yes. And have they followed different depreciation method? Yes. So based on this, I will apply component based depreciation. So this is with respect to charging depreciation with separate components. But ultimately, what becomes important for me? Total depreciation. So how will the total depreciation comes? You will take it on press unit, that is for the cost of 20 lakh, and then electronic panels separately, because compared with straight line and the electronic panels, the useful life is different, method is also different, and then inking and drying system same way of how we solve. Not just one depreciation for the entire machine, that is I cannot uniformly apply either straight line or reducing balance completely on the entire machine cost, because there is component breakup available. I hope you all understood the concept of component based depreciation. Moving on to next thing, cost of property, plant and equipment. This point becomes important because sometimes in question they will just give you other particular costs. So whether to include that cost or not, it becomes very important to understand what includes in cost of property, plant and equipment. So in this cost, what all inclusions are there? You will first take purchase price, and if there is any non-refundable import duties, be very careful, it should be non-refundable. And purchase taxes, whatever taxes you take or whatever you duties you consider, it should be precisely non-refundable in nature. Only those can be included here. Then there should be directly attributable cost. Some examples like transportation, some erection charges, installation charges will all become directly attributable cost. And initial estimate of the cost of dismantling, removing the item and restoring the site on which an asset is located. This is just an estimate. So what does this point here means is, if at the end of useful life of the asset, if the person for whomsoever you are taking the asset on rent or lease wants the asset back in a particular situation as in he handed it before to you, so that will come with certain costs. So if we estimate at the initial period itself, that will also be considered as part of the cost. I've just given a simple example. This has a detailed explanation. You will definitely look at this in your CA inter and CA final level. Yes. So in this, what are the exclusions which we can observe? Cost of opening new facility or business. These are just some illustration cases. Basically, when you have to consider whether should I include this cost or not, you have to first look at some pointers. Whether this particular cost is essential in order to function the asset. If these costs are not incurred, can the asset be not used in a particular situation? It has to be made use of. So these are the points which you need to cross check and then conclude that whether you have to include that cost or not. Next, cost of introducing new product or service. All these are nothing but revenue in nature which does not add to your total functioning of the product. Similar to that, cost of opening new facility or business. It is just a sunk cost which you just incur and just move forward. Then cost of conducting business in a new location or with a new class of customer. So this is again a trial cost. Sometimes businesses incur on. So these are not part of your cost of the asset. This also includes cost of staff training and then administration and general overhead costs. All these will not include to your total cost of the asset. Now, why this point becomes important? Because when we try calculating depreciation, this particular addition or whether exclusion will also impact your ultimate answer. So I hope this was comfortable to understand. Moving on to next, methods for providing depreciation. There are several methods, but most commonly used methods in your questions and in practical life also is straight line method or reducing balance method. It can also be called as written down value method. So let's observe what it says. Straight line method. This method results in constant charge over the useful life if the residual value of the asset does not change. So, what are the factors which we consider with respect to charging depreciation? There will be cost, there will be useful life, and one more will be residual value. This can also be called as scrap value. So, what does this value mean? If I am using the asset ultimately to its complete useful life, at the end of the useful life, I will expect a very nominal amount. If I am able to sell the asset in the market, it is basically similar to the realizable value. So that becomes your residual value or scrap value. So what does it say here? Under straight line method, it will result in a constant charge of depreciation. That is, every year there will be uniform amount of depreciation or uniform rate of depreciation provided the residual value will not change. So, how to calculate depreciation? First, depreciation amount, cost of asset, as I told, three things: cost of asset minus scrap value, divide this by useful life of the asset. Cost of asset minus scrap value is, in other words, called as depreciable amount. So, this divided by useful life will give you depreciation amount under straight line method. So, if in case you have to calculate rate of depreciation on straight line basis, you can just apply this one: straight line depreciation amount divided by cost of the asset into 100. I hope this was clear to all of you with respect to straight line method of depreciation. Next, diminishing balance method. So as the name itself says, the depreciation will reduce year on year depending on the usage of assets. So this results in a decreasing charge over the useful life, because this is very practical. The asset with respect to the benefit you derive or with respect to the efficiency will definitely not be constant in order to put to use in the similar conditions. Therefore, this method of depreciation becomes much more practical because it reduces the value depending upon the impact of functioning of the asset. Next is units of production method. This depends on the number of units we produce. So this results in a charge based on the expected use or output. Purely depends on the usage of assets and not with respect to whether the asset is put to use or not. Next, sum of years of digit method. Depreciation under this method particularly considers number of years in respect of useful life. How to calculate this? Cost of asset minus scrap value. Similarly, what we saw on top for straight line method, this will be multiplied with number of years of remaining life of asset including that year divided by total of all digits of the life of the asset. So what does this mean? For example, if I take total years or total useful life to be 10 years, if there is some cost minus scrap value taken, multiply this with 10 years because it says number of years of remaining life of asset including that year. Here I am calculating for year 1. Multiply this with 10 divided by total of all digits of life of the assets. That means if I have taken 10 years, I have to calculate 1 plus 2 plus 3 plus 4 until 10. So sometimes it was easier for me to calculate now because I've just taken 10 years. So many times there could be different useful life. So at that point of time, what I can do is I can simply calculate by using this simple step, that is n into n plus 1 by 2. Here also I can do the same thing. So my n represents number of useful life. So 10 plus 1 is 11 into 10 divided by 2. So that will be 55. So this was for year 1. Similarly, if I have to calculate for year 2, you'll again take cost minus scrap value multiplied by ninth year divided by 55. I hope you guys are able to connect with respect to sum of years of digit method. Next, machine hour method. So as the name itself says, machine hour, you tend to use the asset with respect to number of hours it is put to use. See, where it is practicable to keep a record of the actual running hours of each machine, depreciation may be calculated on the basis of hours that the concerned machine is worked. So if you are able to ascertain for how many hours the machine is put to use, based on that we can calculate the machine hour method. The machine hour rate of the depreciation is calculated after estimating the total number of hours that machine would work during its whole life. So first of all, there should be actual number of hours which need to be ascertained with respect to usage of machine. Then compare that with total estimated hours you expect the machine to run. So based on that, we will calculate depreciation under machine hour method. Next, production units method. Same approach like what you saw with machine hour method. There the importance was given with respect to hours. Here the importance will be given with respect to number of units. See, under this method, depreciation of the asset is determined by comparing the annual production with the estimated total production. So every year, depending upon the usage of assets, we will ascertain what is the yearly production. Compare that with what is the estimation I can make with respect to the usage of assets with respect to total production. The amount of depreciation is computed by the use of following method. How to calculate? Same. This is the same approach what we also take for machine hour method, but here we just use units. So depreciable amount into production during the year divided by estimated total production. So this is annual production and here we take total production what we estimate from the asset. The method is applicable to machines producing product of uniform specifications because it definitely matters. If you are using the asset with respect to manufacturing of different specified products, this system will not be relevant. So this system will be relevant when you are using this for uniform specifications. Last method is depletion method. This is the most common method which we use when the asset generally is considered based on natural resources. What could be the example? Like your quarries, mines, wherein we can take natural resources, extract, which becomes our asset category. So this method is used in case of mines, quarries, etc. containing only a certain quantity of product. The depreciation rate is calculated. How do we calculate this? By dividing the cost of the asset by the estimated quantity of product likely to be available. Annual depreciation will be the quantity extracted multiplied by the rate per unit. So similar to what we saw under machine hour and product units, under depletion method, you will definitely take the cost of the asset. It can be the license cost which you incur or the lease expense. Multiply it with yearly how much we are able to extract. Divided that by for the number of years you have taken it on lease or for the particular time for which you can use the particular space, that is mine or quarry, what is the estimated quantity you feel that you can extract. So that will give us depreciation under depletion method. So all these methods are simpler enough if you just understand the way of calculating them. We will understand this in detail with respect to questions. Moving on to accounting entries. Now we understood what is depreciation, what impact it will have. Now the question comes, how should it be presented in the books of accounts? So it becomes easier for us if we understand the journal entries. See, there are two alternatives available, first alternative and second alternative. First alternative, when do we choose this? A provision for depreciation account is opened to accumulate the balance of depreciation and the assets are carried at historical cost in the balance sheet. Here the depreciation amount is not reduced from the cost of the asset. So under first alternative, the point here is the business or any organization does not want to show the reduced value of asset. But the point here is depreciation cannot be avoided. It becomes mandate expense to record. So in this case, how will we present the depreciation? We will create a separate account called provision for depreciation. This account will be in the nature of contra asset account. So what does contra asset account means? This we have just created for a temporary purpose with respect to the objective that the businesses does not want the asset value to at reduced proportion. So in this case, what will be the journal entry? Depreciation account debit, because it is a non-cash expense, nominal accounts we will debit. Two, generally we were reducing the value of assets. If the asset value was reduced, we were crediting machinery account. Since we are not recording this with respect to asset or any machinery account, so we will route it through a separate account called provision for depreciation account. Next, this depreciation account is a nominal account. If I have to close the ledger, we will transfer it to profit and loss. So profit and loss account debit to depreciation account. This is first alternative. Second alternative, normally what we do, amount of depreciation is credited to the asset account every year and the asset account is carried at historical cost less depreciation in balance sheet. I hope you all understood the difference between first alternative and second alternative. In first alternative, they will just show it at historical cost. In the second alternative, historical cost minus depreciation. So accordingly, the journal entries will be depreciation account debit to asset account, and then depreciation will be transferred to profit and loss. Now, practically speaking, this becomes respective businesses' choice to either go with first alternative or second alternative. In exam, you will definitely look at the requirement of the question. If they are asking you to prepare provision for depreciation, then we will follow this alternative. If they are not mentioning anything, we will do it normally, that is record the entries in the respective asset account, and separately if depreciation account is required, we can also present that. I hope you are all clear till here. Next, profit or loss on the sale or disposal of property, plant and equipment. See, this point becomes very important. There are two things which comes here. Whenever there is a sale of any asset in a particular year, first you have to calculate depreciation up to the usage of assets the asset is getting sold. After you calculate that, we will have to find out what is the written down value of the asset as on the sale date. So this is one step. Second, compare this with the sale value which will be provided to you. So depending upon the comparison, you will know on sale whether we are making profit or loss. So first of all, to record the entry of sale of the asset, whatever we were charging depreciation, now the depreciation will stop because the asset is no longer present in the business. And for the value of asset going out of the business, we will have to take it out by also recording the sale entry. Along with that, profit or loss on sale will also be shown in the books of accounts, and that ultimately will be presented in your profit and loss statement as well. So what does it say? Whenever any depreciable asset is sold during the year, depreciation is charged on it for the period it has been used in the sale year. So first you have to calculate the depreciation for the particular period it is still used in the business. The written down value after charging such depreciation is used for calculating the profit or loss on sale of that asset. So we will compare written down value with the sale value. The resulting profit or loss on sale of the asset is ultimately transferred to profit and loss account. So you'll understand all these pointers while we solve questions. Next, change in the method of depreciation. So it purely becomes business choice to start with whichever method they feel it is suitable. Over the period while they are following a particular method, there could be circumstances which demands change. At that point of time, what is the treatment we need to provide for the asset account? The depreciation method applied to an asset should be reviewed at least at the end of each financial year. And if there has been a significant change in the expected pattern of consumption of the future economic benefits embodied in the assets. So, when you feel there is a significant change for what? In the expected pattern of consumption, that means usage of asset, the method should be changed to reflect the changed pattern, because it becomes very practical to apply the method which gives you that benefits to record in order to keep the matching concept in relevance, because usage and then the consumption which depends your depreciation calculation. Change in method is treated as change in accounting estimate. We have observed what is accounting estimate. So as per accounting standards, if there is any change in method, we will treat this as a change in accounting estimates. Let's understand this with an example. Cost of the machine is 10 lakh 50, residual value is 50,000 and useful life is 10 years. The company charges depreciation on straight line method for the first 2 years and thereafter decides to adopt written down value method by charging depreciation at 25%, calculated based on useful life. You are required to calculate depreciation for the third year. Third year is the year where the change is reflecting. So for the first 2 years, depreciation will be 10 lakh 50 minus 50,000 divided by 10 years into 2 years. So this is 2 lakh. So in the third year, if I have to check the WDV of the asset, 10 lakh 50,000 minus 2 lakh. So it is 8 lakh 50,000. On this, I will start charging depreciation at 25%. So for third year, the depreciation will be 2 lakh 12,500. So those things are only mentioned here. I hope you understood how to calculate depreciation when there is change in the method. Next, revision of the estimated useful life of property, plant and equipment. See, first of all, whatever useful life we consider is based on the judgmental basis or estimation depending upon the usage of the asset. So sometimes whatever you have assumed initially might not be relevant to carry it forward in the same pattern. So therefore, there can also be a circumstance where the revision is necessary. So what does it say? The residual value, that is whatever you have estimated at the beginning, and useful life of an asset should be reviewed at least at the end of each financial year. And if its expectations differ from previous estimates, the changes should be accounted for as what? Change in an accounting estimate in accordance with accounting standards, similar to what we saw with respect to change in the method of depreciation. Revision in useful life. Unamortized balance shall be charged over remaining useful life of the asset. So based on the useful life which is revised, whatever amount, unamortized means whatever balances is left with respect to written down value, that will be depreciated over the remaining useful life. Let's understand this with an example. A machine costing 6 lakh is depreciated on straight line basis, assuming 10 years working life and nil residual value for 3 years. The estimate of remaining useful life after third year, so this is happening after third year, was reassessed as 5 years. So total life while we started was 10 years. So after 3 years, they are feeling the asset is just used for the balance 5 years. So incidentally, if we have to look after completing 3 years, we'll be still left with 7 more years. But they are reassessing the useful life for 5 years. So calculate the depreciation for fourth year. So 6 lakh divided by 10 will give me yearly depreciation. 3 years they followed the same thing. So 6 lakh into 3 years will be 1 lakh 80. So if I have to calculate the written down value at the end of third year, 6 lakh, which was the cost, minus total depreciation till date. So you will be left out with the asset balance of 4 lakh 20. Remaining useful life as per previous estimate was 7 years. But now this has been reassessed by 5 years. So we will consider the reassessed useful life. So 4 lakh 20 divided by 5 years. So that will come to 84,000 per annum. I hope you are understanding the impact on the depreciation amount due to these changes. Last topic, revaluation of property, plant and equipment. This is again respective business choices to adopt the concept of revaluation. Revaluation is nothing but comparing the asset value to the current market value to just reflect the actual impact it will have with respect to the asset. You are recording it in the balance sheet, since if in future we are going for sale, it gives us the true value or the correct picture rather than historical approach. So, under revaluation, what is the treatment we have to understand? See, there can just be two possibilities. Either there will be upward revision or downward revision. Upward revision means from the balance which you are reflecting in your books of accounts, comparing that with the market value is higher. Similarly, downward revision means the market value is less compared to the recorded value what you have presented in the books. So what is the treatment accordingly? If there is an upward revision in the value of the asset for the first time, then the amount of appreciation is debited to asset. See, first of all, the asset value is more. That means your asset balance, whatever you have recorded in the books, need to be increased. So this increase will be recorded as asset account debit because there is increase in the asset balance. The increase will be reflected through a separate account called revaluation reserve account. See, first of all, this is an imaginary increase. This you are doing this because if you are selling this in the current marketplace, what amount is the true value which is going to reflect? So that's why this increase is reflected in a separate account called as revaluation reserve account. Similarly, if there is a downward revision in the value of an asset, it is nothing but your loss of the asset. So this will be routed through normal profit and loss account. So then profit and loss account is debited. When the asset balance comes down, we will have to credit it. So due to loss, we will debit P&L account to asset account. I hope you understood what to do when there is increase and what to do when there is decrease. The question here comes, when this revaluation impact should be shown in the following subsequent years. How to record this? See, first we'll understand the case with respect to increase in the revaluation. I mean to say increase in the asset balance. Initially, that is first time, it will be credited to which account? Revaluation reserve. Whatever increased balance will be credited to revaluation reserve. Now this was first time. Now assume initial downward revision and subsequently upward revision. So initial downward revision, that means I would have faced the asset loss. So the balance would have been shown to P&L account. Later they feel there is upward revision in the asset. So now in this case, what should you do? When you are recording the increase in the value of asset, first reverse the amount of loss which you have shown. And beyond that, still there are any balance to be recorded, that will be routed through revaluation reserve. So what do I mean by this? Example, assume first year my current asset value is 10,000. If I have to compare this with the market value, assume the balance in the market is somewhere around 8,000. So there is a loss here. So what I will do, 2,000 will be shown in P&L account, right? So this is nothing but initial downward revision. Assume later part of the year, second year, my asset is showing at 8, but when I compare this with the market, it is reflecting it at 12,000. So there is an increase in the value of asset. So first what should I do? There was already 2,000 recorded as a loss. So I will first reverse this 2000. So the balance will be netted off. Now, beyond this 2000, extra 2000 is reflected due to increase in the value of asset. Now, this 2000 will be taken to revaluation reserve account. See, that is what is written here. Recognized in the statement of profit and loss to the extent it reverses a revaluation decrease of the same asset previously recognized in the statement of P&L, and excess, if any, will be credited to revaluation reserve account. Next, if there is decrease in the value of asset, initial downward revision, we will take it to statement of P&L. Initial upward revision and subsequently downward revision. Now the case reverse. First time there was increase in the value of asset. When there was increase in the asset, the balance would have been taken to revaluation reserve. Now subsequently there is downward revaluation. So in this case, similar approach, whatever was created due to increase, we will first reverse that. After reversing anything excess beyond that, it will be taken to statement of profit and loss. See, decrease should be debited directly to owner's interest under the heading of revaluation reserve to the extent of any credit balance existing in the revaluation surplus in respect of that asset, and excess, if any, will be charged to statement of profit and loss. Now, what does this say? Example, first year, my asset was 10,000, but in the market it is worth at 12,000. So to revaluation reserve, you would be showing 2,000 extra. Second year, the asset value became 8,000. So in this case, what is the impact? 4,000 is the total loss. First of all, in this 4,000, 2,000 I will reverse from revaluation reserve, and balance 2,000 I will take it to profit and loss account. I hope this was clear. So this completes all your concepts. Now let's look into questions one by one. See, while we are solving, guys, please make sure you also practice along, because these questions, by looking, it doesn't become a proper memory for you. Once you actually solve, you will literally understand what is the treatment taken. So let's address this one by one. First, a firm purchased on 1st Jan 2020 certain machineries for 5,82,000 and spent 18,000 on its erection. Remember what to include in the cost. So this 18,000 should have been spent if I have to use the assets, because it needs to be erected, that is installed. So this becomes part of your cost. On 1st July, another machinery for 2 lakh was acquired. On 1st July 2021, the machinery purchased on 1st Jan 20, so this one, having become obsolete, was auctioned for 3 lakh 86, and on the same date, fresh machinery was purchased at a cost of 4 lakh. Depreciation was provided for annually on 31st December at the rate of 10% per annum. On which method? Written down value method. First, you have to check what year they are following, and then check the method of depreciation. So in this case, they are following Jan to December, and then 10% on which method? Written down basis. They are asking you to prepare simply machinery account. So here you have drawn the ledger format. You also make sure you practice this with a proper format. Machinery account. Yes. So a firm purchased on 1st Jan 2020. So on 1st Jan 20, what will be the entry when I purchase the asset? Machinery account debit to bank account. So to bank account. Since there were different set of machines used, it is always better to name the machine. So here I will name it as machinery 1. 5,82,000 was cost of the asset. 18,000 is additionally spent on erection, which becomes part of cost of the asset. So 5,82,000 plus 18,000. So this will be 6 lakh. So this was the entry on 1st Jan 2020. In the same year, there is one more transaction. On 1st July 2020, another machinery for 2 lakh was acquired. So same, on 1st July 2020, two bank account, machinery 2. So this value was 2 lakh. In the current year, was there any other transaction? Directly it is moving to 1st July 2021. So we have to close this particular year. This will end on 31st December 20. In this question, remember first alternative, second alternative, they have not mentioned anything about provision for depreciation. So we will record the depreciation with respect to asset account itself. So depreciation account debit to machinery will be the entry by depreciation. We have it for two machines, so we can provide the breakup. For machinery 1, the cost is 6 lakh. On that 10%, it will be 60,000 for the whole year because that was as on 1st Jan. For the second machinery, 2 lakh. This was purchased in between the year. So 1st July to 31st December. July, August, September, October, November, December. 6 months. So the cost here is 2 lakh into 10% into 6 divided by 12. That is 10,000. So your total depreciation will be 70,000. After providing, we will be left out with balances by balance carried down. Machinery 1, machinery 2, machinery 1, 6 lakh minus 60,000, 5 lakh 40,000, 2 lakh minus 10, that is 1 lakh 90,000, 7 lakh 30,000. So the total of ledger will be 8 lakh. This was for first year. So we will bring down the balance 1st Jan 21 to balance brought down. Machinery 1, 5 lakh 40,000. Machinery 2, 1 lakh 90,000. The total is 7 lakh 30,000. What is happening in the second year? On 1st July 21, the machinery purchased on 1st Jan 20. Now 1st Jan 20 means M1. Having become obsolete was auctioned for 3,86,000. So first let's treat this. See, whenever there is a sale happening, obsolete is nothing but you're not able to use the asset for further process. So you're just taking it out of the business. So due to this, it has been auctioned and it is able to fetch you 3,86,000. This is nothing but your sale amount. So we will have to find out what is the profit or loss by preparing a working note. First, WDV of the asset. Which asset? Machinery 1 as on 1st July 21. That is the date where sale is happening, right? On 1st July 21. So we have the value of the asset on 1st Jan 21. That is 5 lakh 40,000. From Jan to July. That is up to 30th June. Jan, Feb, March, April, May, June. So 6 months. This 10% into 6 by 12. This is nothing but we are calculating depreciation for the asset present in the business until 1st July. So 5 lakh 40 into 10% into 6 divided by 12. So that is 27,000. So what is the WDV of the asset? 5 lakh 13,000. This I need to compare with the sale value which is given. That is how much? 3 lakh 86,000. WDV of the asset is more where I am able to fetch only 3 lakh 86. So there will be a loss on asset 1,27,000. Loss on sale. Now this needs to be recorded, whatever items which we considered with respect to machinery 1. See, first of all, on 1st July 21, since the asset is getting sold, I will record the depreciation until that particular date. By depreciation M1 27,000 is what we calculated. Then when the asset is sold, by bank account is what we receive for the sale value. By bank 3,86,000, and then there is a loss. So that will be transferred to P&L account. Loss on sale 1,27,000. So this completes the recording of all connected transaction with respect to machinery 1. On the same date, there was one more transaction. See, on the same date, fresh machinery was purchased at a cost of 4 lakh. So this will be 1st July 21. To bank, I already have machine 1, machine 2. So I will treat this as M3, 4 lakh. Now here for machinery 1, depreciation is already given. There is machinery 2, and along with that there is one more new machinery. So for this we will record depreciation by depreciation machinery 2 and machinery 3. Machinery 2 written down value is how much? 1,90,000. So on 1,90,000, 10%, that will be 19,000. Machinery 3, 4 lakh, 10% for 6 months. 10% into 6 by 12. So that will be 20,000. So total depreciation will be 39,000. So this is done. Let me just take this down. So this is 5,13,000. Yes, at the end of the year, I have to calculate the balances by balance carried down. Machinery 2, machinery 3. Machinery 2, 1,90,000 minus 19,000, 171. Machinery 3, 4 lakh minus 20,000, 3,80,000 plus 171, 5,51,000. So let's close the ledger. 11,30,000, 11,30,000. See guys, it is always better to show if you have different assets as a separate breakup, because it becomes simpler if they are giving you separate sale transactions at the end. This was question number 1. I hope all of you understood this in detail. Next, question number 2. On 1st April 2019, Shubhra Limited purchased a machinery for 12 lakh. On 1st October 21, a part of the machinery purchased on April 1st, 2019 for 80,000 was sold for 45,000, and a new machinery at a cost of 1,58,000 was purchased and installed on the same date. The company has adopted providing 10% depreciation on again which method written down value. Now observe what have they asked. Show the necessary ledger accounts for the year ended 31st March 2020 to 2022, assuming that provision for depreciation account is not maintained. That means whatever depreciation is there, we will record it with asset account itself. Provision for depreciation account is maintained. So then depreciation will be treated through provision for depreciation. Asset account will be shown at historical cost. So first, when provision for depreciation is not maintained, let's take this as a machinery account. Provision for depreciation account. Yes, first. On 1st April 19, Shubhra purchased a machinery for 12 lakh. Let's record this. 1st April 19. To bank. I'll show this as M1. 12 lakh. On 1st October 21. That means next transaction is directly in the year 2021. So when they tell 1st April, they are also telling year ends on 31st March. So let's close this 31st March 2020. There is one asset on which we need to calculate depreciation. Depreciation is on written down value on 12 lakh, 10% will be 1,20,000. This is for the whole year. So on the same date, by balance carried down, 12 lakh minus 10% is 10,80,000. 12 lakh and 12 lakh. On 1st April 2020, to balance brought down 10,80,000. Next transaction was in the year 21. So this year also there is no any other transaction. 31st March 21, by depreciation on 10,80,000, 10%. So 1,08,000. 31st March 2020, by balance carried down 9,72,000. 10,80,000. 10,80,000. Next, 1st April. This is 21. 1st April 21. To balance brought down 9,72,000. Now in this year, 1st October, part of the machinery which was purchased on 1st April, that is 80,000, was sold for 45,000, and a new machinery at a cost of 1,58,000 was purchased and installed on the same date. First of all, entire 12 lakh machinery which was purchased in 2019 is not getting sold. Only a part of it is getting sold. They are exclusively giving part involved here is 80,000. This was sold for 45. So we need to make a working for this. That was given on 1st April 2019. Now this asset is getting sold in the year 21. So for first of all, we have to calculate depreciation until that date. Minus depreciation so this will be 72,000. This is WDV as on 1st April 20 minus depreciation as on 31st March 21 on 72,000 10%, 7,200. So that will be 64,800. This is WDV as on 1st April 21. We want the value as on 1st October 21. So we will calculate depreciation until then. So on 64,800, 10% into how many months? April, May, June, July, August, September. 6 by 12. So this will be 3,240. 61,560. This is the WDV of the asset on the sale date. Now compare this with sale value. Let me just take it. Now sale value is 45,000. So in this case, there is a loss on sale. I hope all of you understood this till here. See, in this case, what happened is, as we have already recorded the transaction till 1st April 21, the depreciation on the part of 80,000 is already been calculated every year where we calculated total depreciation. So this was required in order to understand what is the WDV as on 1st October. So you need not separately record this depreciation, this depreciation, this depreciation, because that is already been taken care. Depreciation in the current year, that is 3240, need to be recorded. So this is happening on 1st October. You're getting how much? 45,000. And then profit and loss, because there is loss on sale, that is 16,560. Done? Yes. So this was with respect to part of the asset which was representing 80,000. Now still there is remaining part on which normal depreciation need to be calculated. Yes or no? So that will happen on 31st March 22 by depreciation part of M1. Before that, in the same year, there was another asset which was bought. See, and a new machinery at a cost of 1,58,000 was purchased and installed on the same date. That is on 1st October itself. To bank 1,58,000. Yes. Now part of M1. How much will be left? See, if I have to take the breakup in 12 lakh, they were telling 80,000 is what is represent. So if I take out 80,000 from 12 lakh, 11 lakh 20,000, 10% first year, 10% second year. So the balance in the third year is 9 lakh 7,200. On this, 10%. So this will be 90,720 M2 1,58,000 into 10% into 6 divided by 12. So that is 7,900 plus 90720. This is your details which has been recorded. Now 31st March 22, by balance carried down, 3240 minus 45,000 minus 16,560 minus 98,620 9,66,580. To balance brought down 966,580. This is on 1st April 22. So this was with respect to when provision for depreciation is not maintained. When provision for depreciation is maintained, the asset will be recorded at historical cost itself, and any treatment with respect to depreciation will be shown in provision for depreciation account. So similarly, let's record this transaction. 1st April 19 to bank, machinery 1, 12 lakh. Since this will be shown at historical cost, no treatment of depreciation will be recorded here. So to bank, 31st March 20, by balance carried down 12 lakh, 12 lakh. In provision for depreciation for that particular year, there need to be depreciation charge. So the entry will be depreciation account debit to provision for depreciation. That happens on which date? 31st March 20, by depreciation 1,20,000. No other event happening on the same date. To balance carried down 1,20,000. First April 21. This is 1st April 20, by balance brought down in the year 2020. Also there was no transaction. Yes, in this year also there is no other particular transaction. So 12 lakh itself will be taken further. First April 21 to balance brought down 12 lakh. In this particular year, in the month of October, there is a sale. So in this case, first, for 1st April 2020, we have brought down the balance of 1,20,000. That year's depreciation needs to be recorded. By depreciation Now the asset was worth 12 lakh minus 1 lakh 20 already taken. On that 10%, so this will be 1 lakh 8,000. So total will be 2 lakh 28,000. 31st March 21 to balance carried down 2 lakh 28,000. 1st April 21. Now in this particular year, there is an asset, part of the asset getting sold. So first of all, while we did provision for depreciation account not maintained, we have already made the calculation. We will use the same thing here. On 1st October, on that part of the asset, we will recorded the depreciation. The same thing we will do it here as well. 1st October 21 by depreciation 3240. So this was with respect to the asset which is getting sold. Now when the asset is getting sold, understand one thing guys, till here what are we doing? We are just carrying it forward the total depreciation. That means the balance of depreciation is getting accumulated. Now this part of the asset is no longer present in the business. Don't you think I have to eliminate this because the asset is no longer present in the business? So what I do now here is in this provision for depreciation account, if you look at the balance, this takes the part of 80,000 and the relevant depreciation charged on that particular asset. So we have to take out the balances of the asset belonging to 80,000. That means depreciation calculated so far need to be eliminated. How do I eliminate this? Provision for depreciation, when we charge depreciation, will be taken to depreciation. So this is coming from asset account. So we will take it to machinery account. 1st October 21 to machinery. On 80,000, first year we had taken 8,000. Remember, second year 7,200 and third year 3240. Third year in the sense partial. 8,000 plus 7,200 plus 3240. This is 18,440. Since we have taken it here, we will record this in the asset account. 1st October 21 by provision for depreciation account 18,440. Now with respect to this, there is a sale also happening. So we will have to record this transaction by bank, which is 45,000, and there was a loss on sale 16,560 by P&L account, loss on sale 16,560. Now here what we did was we completely recorded the asset which was representing for 80,000 gone out of the business. Yes. So on the same date, 1st October, there was another asset which was purchased. New machinery at a cost of 1,58,000 was purchased. So 1st October 21 to bank, machinery to 1,58,000. So 12 lakh plus 158. Twelve lakh 78,000. This is by balance carried down. 31st March 22. In provision for depreciation, I have recorded the asset which was sold. Now remember, there was also other assets along with that. On 1st October, another new asset is purchased. So 31st March 22 by depreciation on part of machine 1. This we have already calculated if you remember. See here 9720 on M2 7900. This will be 98,620. Three lakh 11,420 to balance carried down. 31st March 2022. I hope all of you understood the design of question and the way of solving when you just have part of the assets and when provision of depreciation account is not maintained and when provision of depreciation account is maintained. Let's move to the next question. Question number 3. A firm purchased second-hand machinery on 1st Jan 2019 for 3 lakh. Irrespective of whether it is first hand or second hand, if it is an asset for you, you will record it as a normal asset. Subsequent to which 60,000 and 40,000 were spent on its repairs and installation respectively. Now this becomes a question whether this needs to be added to cost or not. Yes. So without repairs, without installation, I cannot function the asset. So this also becomes part of your cost. On 1st July 20, another machinery was purchased for 2,60,000. On 1st July 21, the first machinery having become outdated was auctioned for 320, and on the same date another machinery was purchased for 2,50,000. On 1st July 2022, the second machinery was also sold off and it fetched rupees 2,30,000. Depreciation was provided on machinery at 10% on the original cost. Now here it is straight line method annually on 31st December under straight line method. So here they are following the year from Jan to December. So you need to be careful there. Prepare the following accounts in the books of the company. The question looks similar to what we have solved before, but here there is one new account which we are going to learn, that is machinery disposal account. So the requirement of the question here is machinery account for the year ending 31st December 2019 to 2022 and machinery disposal account. Now first let's understand what is this machinery disposal account. This is a temporary account wherein you just record all the treatment with respect to the sale of the asset or disposal of the asset in a separate account by creating that as machinery disposal account. How to do that? Let's understand with the question. This is simpler guys, nothing to complicate. Machinery account. Machinery disposal account. A firm purchased second-hand machinery on 1st Jan 2019, subsequent to which 60 and 40 were spent on repairs and installation. To bank 3 lakh plus 60,000 plus 40,000. This will be 4 lakh. On that particular year, there are no other transactions. So 31st December 2019 by depreciation 40,000. How? 4 lakh 10%, 40,000 used for whole year. 31st December 19, by balance carried down 3,60,000. 1st Jan 20, to balance brought down 3,60,000. In the year 2020, there is some transactions which is happening. On 1st July 20, another machinery was purchased for 2,60,000. To bank machinery to 2,60,000. That is 1st July 20. Correct? Yes. So for both of these assets, I need to record depreciation. By depreciation, machine 1, this is an original cost method. Remember guys, uniform amount of depreciation on 4 lakh 10%, this will be 40,000. Machinery 2, 2,60,000 on 10%, that was present in the business just for 6 months, so that will be 13,000. 53,000. In the same year, there are no other transactions. By balance carried down, machinery 1 and machinery 2, 3,60,000 minus 40,000 will be 3,20,000. 2,60,000 minus 13,000 will be 2,47,000. This is 567. First Jan 21, to balance brought down 567. Machinery 1 is 3,20,000 and machinery 2 is 2,47,000. What is happening in 21? On 1st July 21, the first machinery having become outdated was auctioned for 3,20,000. So first let's understand this transaction. Having become outdated, it was auctioned for 320. That means it is going out of the business. So in that particular year, we will have to record the profit or loss and also show the depreciation until that particular date. So this is happening on 1st July 21 by depreciation. This is for machine number 1. On 3,20,000, 10%. See here, we are not following WDV. It is straight line method. So 40,000 will be depreciation amount. But since this is sold on 1st July, it will just be used for 6 months. So 20,000 will be the depreciation. Now remember guys, if this was a normal machinery account, we were recording all the sale and as well as profit or loss here itself. They have asked you to prepare a separate account called machinery disposal. So we will transfer the respective balance to that particular account. After providing depreciation, I will transfer the balance to machinery disposal on 1st July 21, and there we will record all the sale transaction by machinery disposal account. What is the value? See, 320 minus 20, so that will be 3 lakh. Clear? Now coming to machinery disposal, 1st July 21, to machinery account. This is for M1, 3 lakh. Now when I am selling the asset, how much I am able to receive? 3,20,000. By bank, 3,20,000. Now you are getting more on sales. So you are making profit on sale. How much? 20,000. So to P&L account, profit on sale 20,000. Clear with this? So this was with respect to machine number 1. So after treating machine number 1, there was also one more asset, machine number 2, and there was one transaction additionally happened. Another machinery was purchased for 2 lakh 50. So let's record the depreciation for these dates. Machinery 2, 22 lakh 60,000 on that 10% that was used for whole years. So 26,000 on machinery 3, 25,000 in 2 lakh 50,000 into 10% into 6 by 12, 12,500. So let's close in 2021. That much was the transaction available. Machinery 1 is completely gone. Machinery 2 and machinery 3. 2 lakh 50 minus 12,500, that is 237,500 plus. On 1st Jan 22, to balance brought down, machinery to 2 lakh 21,000, machinery 3 237,500. So this is 458,500. What is happening in 22? On 1st July 22, the second machinery was also sold off and it fetched 2,30,000. So first on 1st July, similar to what we did, we will have to calculate depreciation until 1st July for the second machinery. 1st July 22 by depreciation, machinery 2. See, it was 2,60,000 and that 10% was 26. Since middle of the year, so depreciation will be 13,000. Remember, there is machinery disposal account, so I will transfer the balance to machinery disposal by machinery disposal account. How much? 2,21,000 minus 13,000, that is 2,08,000. Coming to machinery disposal, 1st July 22 to machinery account, 2,08,000. By bank, what is the sale value? 2,30,000. So this is also fetching us profit, 22,000 profit to P&L account. Two lakh 30 and 2,30,000. So we have completed the sale transaction in this. Any other transaction in that particular year? No. Machine 2 was getting sold, so we have machine number 3, which is supposed to be calculated for depreciation by depreciation. Machine number 3, 2,50,000 was what the cost of asset. On that 10%, 25,000. By balance carried down, 237,500 minus 25,000. That will be 2,12,500. First Jan 23 to balance brought down. Machinery 3, 2,12,500. Yes, I hope you guys understood how to present machinery account and machinery disposal. So in machinery disposal, what you have to do is just take out the current value and then record all the sale transaction there. That's it. So nothing additional. You will do it as we learned in provision for depreciation account. Yes. Moving on to the next question. On 1st April 2019, a firm purchased a machinery for 2 lakh. On 1st October in the same accounting year, additional machinery costing 1 lakh was purchased. On 1st October 20, the machinery purchased on 1st April having become obsolete and was sold for 90,000. On 1st October 21, a new machinery was purchased for 2,50,000 while the machinery purchased on 19 was sold for 80,000. The firm provides depreciation at 10% on original cost on 31st March every year. Show machinery account, provision for depreciation and depreciation for the year of 3 accounting years ending 31st March. See, when they are mentioning about provision for depreciation, that means machinery should be recorded at historical cost. I hope that point is now clear. Now, this particular question will give you that good practice to understand after what we saw in previous questions. And then depreciation account. Right. On 1st April 19, a firm purchased a machinery for 2 lakh. So 1st April 19, 2 bank machinery 1, 2 lakh. On 1st October in the same year, 1st October 19, 2 bank machinery 2, 1 lakh was purchased. On 1st October 20, the machinery purchased on 1st April 19 having become obsolete was sold off for 90,000. So first let's close the balances for this year. 31st March 20 by balance carried down 3 lakh since this is maintained at historical cost. Machinery 1 is 2 lakh and machinery 2 is 1 lakh. Here machinery 1 is 2 lakh and machinery 2 is 1 lakh. So in the first year, depreciation account debit to provision for depreciation. So 31st March 20 by depreciation, machinery 1 and machinery 2. This was 10% on which method? Original cost. So 2 lakh 10% 20,000. Then 1 lakh into 10% in the month of October. October, November, December, Jan, Feb, March. So 6 months. That will be how much? 1 lakh into 10% into 6 by 12. That is 5,000. 25,000. 31st March 20 to balance carried down. First April 20 by balance brought down. This was provision for depreciation. They've also asked us to prepare a depreciation account, so the same will be reflected to provision for depreciation. $25,000. Machinery 120. Machinery 2 5. So depreciation is a nominal account, so it will not have any balancing figure. We will directly transfer it to P&L. By P&L account, 25,000. Done? Yes. Next year, what is happening in the next year? On 1st October 20, the machinery purchased on 1st April 19, having become obsolete, was sold for 90,000. So first on 1st until 1st April 20, we need to calculate depreciation. This was for machinery purchased on 1st April 19, means it is talking about machinery 1. So in provision for depreciation, 1st October 20 by depreciation, machinery 1 20,000 used for 6 months means 10,000. Now remember, when there is provision for depreciation used, we need to remove all the balances which are getting accumulated when the asset is getting sold. So we have taken the depreciation till the year of sale. So 1st October 20 to machinery account. On M1 we had given 20,000 plus 10,000 now. So 30,000 taken out by provision for depreciation, 30,000. So this records your total depreciation. There is a sale value which needs to be taken. Sold off for 30,000. So by bank, 90,000. So if we calculate WDV of the asset as on 1st October 2020, it was how much? 2 lakh minus 30,000. That is total depreciation charged till here. This is 1,70,000. Sale value of the asset is 90,000. So there is a loss 80,000. By P&L account, loss on sale 80,000. So this completes the transactions connected with machine 1. So machine 2 will carry forward as it is. On 1st October 21, new machinery was purchased. So this current year, there are no other transactions. 31st March 21, by balance carried down, M2 1 lakh, first April 22, to balance brought down, so this is 1st April 21. We have completed the transaction connected with machine 1. So there was machine number 2 lying in the business. So for that we have to record the depreciation. 31st March 21, by depreciation, machinery 2 was bought for 1 lakh. So on 1 lakh 10% means 10,000. So in the year 2020, those are the only transactions. The balance carried down 31st March 21. Now this is from machinery 2. First April 21, by balance brought down 15,000. 31st March 21, to provision for depreciation 31st March 21. This is with respect to M2 10,000. Before this, on 1st October also we have charged depreciation. Thirty-first March 21, by P&L account 20,000. 20,000. So this is until 31st March 21. What is happening in the year 2022? 1. On 1st October, a new machinery was purchased for 2 lakh 50, while the machinery purchased on 1st October 19, that is your machine number 2, was sold for 85,000 on the same date. On 1st October, new machinery was purchased. 1st October 2021. To bank account, machinery 3, 2 lakh 50,000. Correct? 2 lakh 50,000. Machinery purchased on 1st October 19 was sold for 85,000 on the same day. So machinery 2 is also getting sold now. First October 21, machinery 2 balance was how much? 5,000. That is with respect to depreciation. With respect to cost, 1 lakh. On that, 10% into 6 by 12. So that will be 5,000. First October 21 to machinery account with respect to machine number 2, it is 10,000, that is 15,000 plus 5,000, 20,000. So by provision for depreciation, 1st October 20,000. By bank, this asset is getting sold for how much? 85,000. So if I have to calculate profit or loss, observe here guys, 1 lakh was the asset cost. Upon that, to 20,000 is depreciation already taken till now. 80,000 is my WDV. Comparing that with the sale value 85,000, 5,000 I'm making what? Profit. So first October 21, since I'm running short of space here, so I directly told you as a working note, you can write it down like we have done it for the first machinery which got sold. So to P&L account, profit on sale, how much? 5,000. Now here what we did, we have recorded the complete transaction with machine number 2. So in the year 21, is there any other transaction? That's it. March 31, 22 by balance carried down. So machinery 3 will be left out. 1 lakh 3,55,000. 1st March 22 to balance brought down Machinery 3, 2,50,000. Provision for depreciation. There was one more machinery which was bought. So for that depreciation will be 31st March 22 by depreciation. I bought it on which date? 1st October. 2 lakh 50 upon that 10% into 6 by 12. So that will be 12,500. This is 32,500 minus 20 to balance carried down 31st March 22. Depreciation account to provision manage on 1st October 21 to provision for depreciation. How much? 5,000. And to provision for depreciation 12,500. This is on 31st March 22 by P&L account. 17,500. Yes, they had asked us to prepare the accounts for the 3 year ending 31st March 2022. So we have done with respect to machinery, we have done it with respect to provision and then depreciation account. I hope all of you are able to understand. This was one such question which will help you revise to whatever we discussed from the previous question, guys. Be very careful. It doesn't impact if you just listen to the video. It becomes more valuable as you practice it along. Take the question separately after you watch the video, have understood the question, and try to solve it by your own to just cross check whether you have understood and you are able to follow the steps to solve here. Yes. Next question. The machinery account of a factory showed a balance of 19 lakh on 1st Jan 2022. See here guys, in this question it is starting with a different approach. Till now what we saw was some asset was purchased in the same year as we prepared the ledger accounts. But here the asset account is showing a balance of 19 lakh on 1st Jan 2022. So its accounts were made up on 31st December each year and depreciation is written off at 10% per annum. So we are following Jan to December under the diminishing balance method. So this is very important to observe here. On 1st June 2022, a new machinery was acquired at a cost of 2,80,000 and installation charges incurred in erecting the machine works out to 8,920 on the same date. On 1st June 2022, a machine which had cost 4,37,400 on 1st Jan 2020 was sold for 75,000. Another machine which had cost 4,37,000 on 1st Jan 21 was scrapped on the same day and it realized nothing. Write a machinery account for the year 2022 allowing the same rate of depreciation as in the past, calculating depreciation to the nearest multiple of a rupee. So here they are giving you some balances. In between, there are some part of the assets which was valued so much in the respective year, which is getting sold in the current year, and they are asking you to present the machinery account for the year 2022. So machinery account showed a balance of 19 lakh on 1st Jan 2022. To balance brought down. Can I write it like this? Because it's showing a balance of 19 lakh. And depreciation is written off at 10% under the diminishing balance. On 1st June 22, a new machinery was acquired at a cost of 2 lakh 80 and installation charges incurred in erecting works out to 8920. That means isn't in the same year? Yes. So 1st June 22 to bank account 2 lakh 80 plus 8920. That is 2,88,920. So this we have recorded until the new machinery being purchased. Further, on 1st June 22, a machine which had cost 4,37,400 on 1st Jan 2020 was sold for 75,000. So on 1st June, which had cost on 1st Jan 2020, it is always better to prepare a separate working note for this because it is starting from 2020. We are supposed to calculate profit or loss in the year 2022. So WDV of the asset as on 1st Jan 22, that is 437,400. Correct? On 1st Jan 2022, that is 437,400. So 10% on diminishing balance method, we will have to arrive at the value as on 1st June 2022 minus depreciation at 10%. So this will be 437,40 393,660. This is WDV of the asset as on 1st Jan 20, sorry, this is WDV of the asset as on which date? 1st Jan 2020. So we will get the value as on 1st Jan 21 minus depreciation at 10%. So this will be 393,660. 393,660 minus 10% will be 3,54,294 minus dip. So this will be my WDV of the asset as on 1st Jan 22. So in the current year, it is used till June. So we will calculate the depreciation for how many months? The asset is getting sold on which date? On 1st June. The asset is getting sold on 1st June. So Jan, Feb, March, April, May. Because it is sold on 1st June for 5 months. So 3,54,294 into 10% into 5 by 12. The value is coming to 14,760 to 354 294 minus 14,762, 339,532. So this is the WDV of the asset as on 1st June 22 minus sale value. What is the sale value being offered? 75,000. So there is a loss of 2,64,532. Loss on sale. Now we need to record this in the year 2022. Remember guys, we did this calculation because we wanted to know what is the WDV of the asset as on 1st June 2022. Because we need to compare this with sale value and then find out profit or loss. So don't you think for the year 2020 and 2021, the transaction with respect to depreciation would have already been recorded. So the question is clearly asking us prepare it for 2022. That means we will have to record the transaction with respect to 2022. So in 2022, if you observe, we have depreciation which needs to be recorded and sale with respect to loss on sale. 1st June 22 by depreciation, that is 14,762 by bank 75,000, 2,64,532. This is by P&L account, loss on sale. I hope this is understood to all of you. Connected to this, another machine which had cost 4,37,000 on 1st Jan 21 was scrapped on the same date and it realized nothing. Don't you think we have to follow the similar steps? So this machine which was costed as 4,37,000 on 1st Jan 21. Four lakh 37,000. So we want it on 1st June 2022 minus depreciation at 10%. This is 43,700. 3,93,300. WDV of the asset as on 1st Jan 22 minus depreciation at 10% for 5 months, 393,300 into 10% into 5 by 12. So this will be 16,387. Since the question specifies that you need to round off to the nearest multiple of a rupee, so we can also take this as 16,388, 393, 300 minus 16,388, 376,912. This is WDV of the asset as on 1st June. So this was completely scrapped. So total value will be a loss. 1st June 22 by depreciation 16,388 by profit and loss account. Loss is 376,912. Now, if you observe in the question, the total balance of the machinery was 19 lakh. So we have worked out in parts. So don't you think out of 19 lakh, see, this is the WDV of the asset as on 1st June. And also there is WDV of the asset on the 1st Jan. Sorry, not June, Jan. Can we remove this from 19 lakh? Because this balance of 19 is also telling me on 1st Jan. So I will still have the remaining asset balance, which should be subject to depreciation. Yes or no? So let's calculate balance asset 19 lakh minus 354 294 minus 393 300. So 19 lakh minus 354 294 minus 393 300. So that will be 11 lakh 52,406. So on this, I will have to charge depreciation for the year end, that is at 10% on which method? Diminishing balance. So this will be charged as on 31st December 22 by depreciation 11 lakh 52,406 into 10%. So that will be 1 lakh 152 4 1 1 lakh 15,241. All of you understood this? I hope we have recorded all the transaction which is given in the question. So we will close the account. $19 lakh plus 288 920 2188 920 minus 14,762 minus 75,000 264,532 minus 16,388 376,912 minus 115241 13,26,085 by balance carried down 1st Jan 23 to balance brought down 13,26,085. Clear, guys? This question was pretty simpler, but it had some back calculations to be done. So working note becomes very important part of your answer. Make sure you do it properly. Moving to the next question. A machinery costing 20 lakh is depreciated on straight line, assuming 10 years working life and nil salvage value for 4 years. The end of the 4th year, the machinery was revalued upwards by 80,000. The remaining useful life of the machinery was also reassessed as 8 years at the end of the 4th year. So calculate depreciation for 5th year. So first, let's do that. Cost here is 20 lakh. Useful life is 10 years. There is no salvage value. So depreciation per year is equal to 20 lakh divided by 10 years. That will be how much? 20,000 per annum at the end of 4th year. So we need to take the depreciation for 4 years. WDV of the asset at the end of 4th year That will be 20 lakh minus 80,000. That is 19 lakh 20,000. Yes. So now this was revalued upwards by 80,000. So the remaining useful life of the machinery was also reassessed as 8 years at the end of the fourth year. So revalued asset value will be 19 lakh 20 plus 80,000. So this will again incidentally be how much? 20 lakh. The remaining useful life of the machinery was also reassessed as 8 years. So depreciation for fifth year will be 20 lakh divided by 8 years. That is 2 lakh 50,000 per annum. So this includes both upward revaluation and revision in the useful life of the asset. Last question. Amazing Group had property, plant and equipment with a book value of 35 lakh on 31st December 2022. The balance in revaluation surplus on that date was 3 lakh. As part of their practice of revaluing the assets on yearly basis, another revaluation was carried out on 31st December 2022. Evaluate the impact of revaluation if the fair value as a result of revaluation done on 31st December 2022 was. Individual cases are given 37 lakh, 33 lakh and 31 lakh. Also give the journal entries. So first let's take case 1. If fair value of the asset is rupees 37 lakh. Now this is the values given as on 31st December. As on 31st December, book value of the asset was how much? 35 lakh. So if you observe, comparing this with book value, is the asset increased or decreased? There is an increase in the asset. So further increase will be recredited to which account? Revaluation reserve account. So the journal entry for this will be property, plant and equipment account debit to revaluation reserve account. The increase is by 2 lakh and 2 lakh. So therefore, balance in revaluation surplus opening was already 3 lakh plus current year 2 more lakh. So total will be 5 lakh. Next, if the fair value is 33 lakh, now book value of the asset was 35 lakh. There is increase, decrease, there is a decrease, but there was already a balance in revaluation surplus that was around 3 lakh. Now if you observe, the decrease is only 2 lakh. So if there was any balance available in revaluation surplus, we will first reverse that. So in this case, there is excess balance available in revaluation surplus. The amount of shortfall is just 2 lakh. The balance in revaluation surplus is already 3 lakh. So this balance is enough for us to set off the the decrease in value of the asset. So what will be the journal entry? Revaluation reserve and the asset was increased, they would have credited. So we will reverse it. Revaluation reserve account debit. So I will only use 2 lakh, right? This to which account? Asset account is what? Property, plant and equipment account. This is 2 lakh. Clear? Yes. So if I have to check balance in revaluation surplus, opening was 3 lakh, utilized in current year is how much? 2 lakh. So I'll be left out with 1 more lakh. Next, if fair value is 31 lakh, book value of the asset is 35 lakh. So there is a downward revision of 4 lakh. Balance available in revaluation surplus was 3 lakh, but the total decrease is how much? 4 lakh. 1 lakh is shortfall. So beyond the balance left, we will take it to profit and loss account. So how will this be recorded? First, revaluation reserve account debit. I'll make use of complete 3 lakh. Then extra 1 lakh will go to profit and loss account, to property, plant and equipment account. So the total decrease is 4 lakh. So balance in revaluation surplus will be 0. Since we had opening 3 lakh, utilized in the current year full 3 lakh. This was all the important set of question, guys. I hope each one of you have gained that value, whatever for the time you have spent with respect to good set of questions. This definitely requires a practice from your end also. Make sure you solve it individually once from your end, guys. I hope you have understood each and every problem in a simpler way. If you feel there is some sort of confusion, make sure you go through the video one more time so that you get more clarity. Prepare really well, guys. You are doing your best. Do not give up. Stay healthy. Stay consistent. This will definitely give you a good results what you are expecting for. Until I see you next time, take care, guys. All the very best.